It's been a slow start. We're very early in the year, but it's been a pretty bad January and nothing over 10 billion, I think, globally. Can we or should we deduce anything about the year ahead from that?
No, I think it's too early. 3 weeks does not a market make, as you know. We had a very strong fourth quarter. The volumes were up 20%. Business finished 2% off, fourth highest ever. If anything, I'd say the macroeconomic environment and some of the geopolitical issues we've talked about, maybe even slightly more benign than last year. We got a phase one deal with China, a little more clarity around what's going to happen in the UK with Brexit. Okay, we got slowing GDP in the West. We get that in China. But still in all, I think it's still pretty much a risk-on market, at least through the first half.
But when I look back at 2019, we had, as you say, there was a lot of uncertainty going in. There was a lot of volatility throughout the year, geopolitical and market. And yet the M&A market kind of punched through all of that. We had one of the best years on record. So going into this year, if it is slightly better, notwithstanding the uncertainty around the election, what is going to drive or curtail activity?
Well, look, I think to your point, that it is a little better. Remember, this is a 6-year cycle now, 6+ years. At some point, trees do not grow to the sky. At some point, we will get a downturn. Query whether it's now or it's a year or two out. I'm not smart enough to make that judgment. Look, the positive things this year, you got lower capex. Organic growth is hard to come by, so I think that'll drive deal making. You have very low financing costs, as you know, that remain. And just again with the mega deals, we haven't seen any this year, but they were the 21 deals north of $20 billion last year were a quarter of the volume. So from a positive side, if we have big deals, that'll do good things for volumes. If that comes off, then we've got to make it up in what I'd call the more middle market and some of the smaller deals, which were down dramatically last year in terms of number of deals.
I was going to say, last year they were down by about a third the $1 billion plus deals. So I guess another question is what drives that discrepancy? Because you had, as you say, a lot of very big deals, but then a real slowdown in kind of the mid-market bread and butter
look,
deals.
we've talked. I mean, I think I talk about this literally every time I come on now. I mean, the technology disruption is radically changing the way we live and work. I think now you're going to get more pressure on the ESG front around sustainability. You saw BlackRock's, Larry Fink's letter. So I think there's going to be a lot more pressure around companies. And part of that is going to result in using M&A as a tool in the toolbox, as it were, to sort of ultimately continue to sustain growth and maybe promulgate some of these sustainability goals.
What about CEO confidence? Because there's this divergence at the moment that we've seen between consumer confidence on the one hand being very high, CEO confidence sort of gradually dwindling through last year, remaining quite low at the beginning of this year. Does that change the activity in the M&A market, or is it, again, just something, as you say, 6 years into the cycle, maybe CEOs don't need that much confidence to do M&A?
Well, look, we've managed to transact through, as you say, CEO confidence has been coming down for a variety of reasons. Consumer confidence is very high. We're still in a low volatility environment. So I think there are a lot of positives in the ledger that would suggest continued deal volumes. And look, things like it's more of a domestic market, right? Cross-border volumes are way down, with the push against globalization. I don't see that changing radically. I mean, unless we get into an environment that becomes much more benign from a regulatory perspective. We did get FIRMA, which I think is helpful in terms of clarification. But it does suggest that the United States is going to look at technology transfers away from change and control deals and just say, look, is this good or bad, ultimately for national security and critical infrastructure? And we should be doing that.
Talking about technology deals, obviously you guys involved with the Xerox deal, which is kind of out there in the market at the moment. Domestic deal, potentially with HP. What should we expect to happen next there?
Look, as you know, Ed, I'm not in a position to really comment on anything that we're involved in. I mean, I do think that, just more broadly around the environment, we're in an environment where I still think it's a risk-on market, and I think that there is an opportunity for companies to do bold things.
In CFIUS, you said we got the new guidelines that are coming into force, I think, early next month. It gives some clarity, and some of it obviously is what we expected around sort of much harsher guidelines of anything in critical technologies, much harsher treatment of anything emanating from China. Do you think now that we have a clearer picture, companies are going to sort of reassess some of these deals and maybe come back to the table?
I think they could. Look, an obvious answer that where there's been a big dampener on activity has been semiconductors. Could we see some? I still think it's a bold. This phase one agreement it's very early days. There's a lot of stuff in that's been kicked down the field for a later date. Does it stick? Will it continue? I think it takes a bold soul to step in at this point right now and do a transaction where you need material Chinese approvals.